Welcome back to the Engineered Impact Podcast. Today, we're going to talk about kind of a follow-on to our last conversation. So in the last episode, I introduced you to the idea that savers are losers, okay? And we talked about some very specific reasons why you can't save your way to financial freedom anymore. Historically, a couple of generations back, people could put their money to work in safe, conservative vehicles and have enough money to retire on. And that's just not the world we live in anymore. And so today I want to focus on a little bit of how we need to shift what we do so that while we do need to save to have capital to invest, how we can be successful as investors, which is what we've all been forced into doing. Okay. Now, one of the very first things that most of us are taught is that we need to focus on building up a big pile of money inside a qualified retirement account, right? What we're taught as our net worth, right? We focus on our assets, what our liabilities are. We want as many assets as possible and as few liabilities as possible. And the difference is our net worth, right? And the main place that we want to build up our pile of money or our assets is in our qualified retirement account, right? 401k, your IRA, 403b, whatever it is that you've got. Okay. So one of the first questions that I think we should be asking that a lot of us don't ask is, well, how big does that pile of money need to be, right? When I was in college, I think it was my second to last year of college, I took a personal finance class. And the very first day, our teacher told us that our generation was going to need $8 million to retire. And when I heard that, I thought, that is insane. Maybe 1 or 2 million, but 8 million is just crazy, right? But whatever, it's his class. So, he taught us how we were going to be able to do that. I went through the whole class. It was a great class. But at the end of it, I was still extremely skeptical that I could ever save up $8 million, right? So when I got into the workforce and I started saving for real and started kind of learning about how, what's it going to take to be retire, right? I learned about something called the 4% rule, which is a very common technique used to kind of gauge how much you would need to retire on. And so the idea is if you have a big enough net worth, you should be able to withdraw 4% of your assets and the market will make up for that every year, right? So essentially you're living off the interest that your nest egg is generating, okay? So for example, if you wanted to live a $100,000 lifestyle, which the first time I sat down, I figured that sounds like a lot of money. I could live on 100K a year. So I divide that by 4% and came up with a number of $2.5 million. And I thought that sounds a heck of a lot better than 8 million, right? So let's go with that, $2.5 million, okay? Well, a few years goes by, I'm struggling, I'm learning a lot. I've learned about things like taxes and inflation and fees and some of the stuff I talked about in the last episode that we're gonna chip away at my nest egg over time, right? And I realized that I was looking at the time, I was, I don't know, 35, 36 when I was really sitting down and kind of thinking through this. And I realized if I'm 35 now and I want to live to 95 was how I was doing my math. That's a 60-year time horizon, right? So I thought, okay, I got to know what is the real number, right? How much do I actually need? And so I sat down, did what any good engineer does. I pulled up a spreadsheet and I thought, okay, if I want to retire at 55 years old, and I picked a number, I think it was 90 or 100K. That's what I want to live on because it sounded like a lot of money at the time. And then I did my best to estimate what are tax rates going to be, right? I wanted to retire at 55 and I figured I'd live till 95. That sounded like a good long life, okay? So I did my best to estimate what are tax rates going to be during that whole period, right? What's inflation going to be during that period? And I found out, on average, inflation's 3%. So I factored that in. And I made some assumptions about market returns and I did all this stuff, right? And at the end, I sat back and the number at the bottom of my spreadsheet was $8.3 million, okay? Which sounded crazy, but lo and behold, that was awfully close to that $8 million that my financial teacher told me I was going to need, right? So I was like, well, crud, I was nowhere on track to save up $8 million. That was for sure, okay? And the other thing I did next was I thought, well, how much am I even going to make in my entire career? And so I pulled up another worksheet, ran some numbers there, made some estimates about average raises and how many times I'd be promoted in my career and things like that, to calculate how much was I going to make during my entire career. And that number was only like $5 million and change. Okay. So if I was only going to make $5 million and I was going to need 8.3 million to retire, I had a big problem, right? That was a huge gap that I was trying to close. Okay. And yes, obviously, there's market returns and things like that, but still, that was a huge delta. Okay. Now, the reason that money needs to be so big is because what I just mentioned, right? The whole time you're building up your nest egg, that net worth, the whole time you're retired, those four powerful forces I talked about in the last episode are eroding the purchasing power of your savings, right? The fees that you're paying the people monitoring your retirement account and the individual mutual funds and the bond funds, all of those people are skimming fees off the top. That whole time, that whole 60-year time period, they're taking money off the top, right? Then you've got 60 years worth of inflation. And even at 3% a year, that ends up being a huge eroder of your purchasing power. Okay. And so what was 100K when I retired at 55, or even when I was 35 looking at it, where it sounded like a lot of money, by the time I was 65, 75, 85, 95, 100K wasn't going to buy me that much if inflation's only 3% that whole time. And so that number's got to keep going up, right? Which is a huge part of why that $8.3 million was $8.3 million. Okay. Now, on top of that, if I'm taking money out of my qualified retirement plan, the IRS is taking some unknown percentage of that money before I ever get to see it, right? Now, when I was running the numbers, that was between 30 and 40%. Okay. And we talked in the last episode again that the typical pitch is, well, you're going to be in a lower tax bracket, right? Because your house is going to be paid off and you're not going to have kids and yada, 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 right? But so you're going to be in a lower tax bracket. Well, I have two problems with that. The first is that's code for you're going to retire poorer than you are today, which doesn't sound like a good deal to me. I don't want to be poorer in retirement than I am now, right? The money that used to be going to pay for my kids and pay for my mortgage and pay for my cars and all those things that I don't have anymore. Well, now that's the money I have to go visit my grandkids and go travel and go do whatever it is I want to do, right? I don't want to lose that. I don't want a subsistence living in retirement. So I don't want to be in a lower tax bracket, for one thing, okay? But the other thing is the U.S. government is spending money like a drunken sailor, okay? So you got that going on. You've got Social Security and Medicare, which are hopelessly underfunded. They're approaching insolvency, okay? I think I mentioned in the last episode that Social Security Administration publishes every year a report that it gives you a date you can circle on the calendar of when they're going to run out, when the trust fund will be depleted, right? That's 2035. Well, since I recorded that the other day, because of the COVID-19 disaster that's gone on, and I think we're up to like 40 million people that have lost their jobs and are no longer paying Social Security taxes, all of a sudden that date went from 2035 to 2029 is when they're estimating that Social Security will be out of money, okay? It's 2020. That's not that long from now, okay? So when I look at that, Social Security is underfunded, Medicare is underfunded, the U.S. government has 25 trillion and counting in debt. I cannot envision any reasonable future where tax rates are substantially higher than they are today, right? So even if you retire in a lower tax bracket, odds are that lower tax bracket is going to be higher than what you're paying today, okay? Now, maybe it's not, but again, I don't see a reasonable scenario where that's not the case. So when I'm doing the math, I got to plan for higher tax brackets, okay? But no matter what they are, you have no way of knowing what those are. You can't reasonably put that in your spreadsheet because there's just no way of knowing what they'll be, right? So we've got fees, we've got inflation, we've got taxes. The fourth thing is, along the way, as you go through your career, the stock market's going to go up and down, right? So you're going to have stock market crashes. We just had one 2 months ago, okay? Markets fell like 30%. Now they've recovered some, but the effect of that was that reset everybody's compound curve, right? When you sit down with your financial advisor at the beginning of your career and periodically throughout your career, they're going to tell you, the stock market's going to grow 8 to 12%, and they're going to show you this nice, smooth compounding curve, right? Well, when you look at a compound interest curve, it's slow and doesn't grow very much for quite a while. And then you get 20, 30, 40 years in, and then you get that knee in the curve where it takes off. And that's where the magic of compound interest happens, right? The problem with that is that's not how the stock market works. Every time there's a dip, okay, you think about what happens, that compound interest curve gets interrupted and it drops. Well, it resets the basis for that curve, and it extends that low growth period, okay, which means it moves that knee in the curve further out, okay? So that happens too many times in your career, well, you may never actually get to that knee in the curve, okay? That's a problem, obviously, especially if you're only going to make $5 million, you need $8.3 million to retire. You are definitely banking on that magic of compound interest to solve that problem for you, okay? So when I looked at this and I said, okay, I've got fees, I've got inflation, I've got taxes, and I've got market losses that are going to eat away at this money my whole life, it's really hard to say that even the $8.3 million is going to be enough, okay? And so when I looked at this mountain of money that I had to build, this $8.3 million, I just didn't have any confidence. I had no certainty that I could ever get there. And even if I did, by some miracle, I wasn't sure that 8.3 would ever be enough, okay? So one of the biggest problems with your mountain of money is that it just sits there, right? It's an easy target for these forces, okay? For the taxes, the fees, all of that stuff. When it's sitting in your account, there's nothing you can do about the fact that, you know, the Wall Street folks are just going to skim off the top the whole time, and inflation is going to eat away at it. And it's sitting there waiting for the IRS to decide whatever the tax rates are going to be. It's sitting there to be impacted by market losses. There's just nothing you can do about it. It's just a big sitting target, right? Now, if you think about your net worth as a mountain of money, I've been using that analogy, right? As this mountain of money. For one thing, it's a big target, right? And the problems with those, besides it being a sitting duck, there's a couple of other problems, right? You made some pretty big assumptions about that time frame, right? Or about that number, that $8.3 million. There was a lot that went into that, right? The first was, I'm going to retire at 55 and only live to 95, okay? Well, again, that was a 60-year time frame from when I was 35 looking at it. But what if I live to be 115? Okay, that's an extra 20 years I didn't plan on. That's a big problem, right? If my money runs out when I'm 95 and I live to 115, what am I going to do the next 20 years? Okay. The other problem is you only get one career. Okay. So if I'm banking on my entire future, whatever that number is, if I live to be 95, 115, 130, whatever it is, if I'm banking on that future on the size of the mountain that I'm able to build during that one career, and then the mountain doesn't turn out to be big enough, guess what? I only had one shot at it. I only had one shot to build the mountain, and it didn't work. I didn't get there, okay? And I can't go back and start over at 25, right? I can't go start a new career. I guess I can go be a Walmart greeter, but I'm certainly not going to be living a $100,000 lifestyle at that point, right? So if I'm not going to make enough in my career to come anywhere close to saving the kind of money that I need, and if there's no way to know if my assumptions about market rates and inflations and tax rates and my lifespan are correct, it leaves me with a big problem, right? I can't have any confidence that I'm on track to live the kind of lifestyle that I want to live, to retire, let alone ever be financially free, okay? So what can I do instead that has a higher probability of success, okay? Well, if I go back to first principles and think about it, what is the principle for having that mountain of money in the first place? Okay. Well, the whole reason I needed to build that mountain was so that I could create the one thing that I actually need to retire on or to be financially free, right? What is that one thing? It's income. Okay. I need that mountain of money so that hopefully it's generating some kind of interest rate or market return that I can skim off as income. Okay. Well, if income is what I'm ultimately going for, rather than having a big pile of money, why wouldn't I start to focus on that now? To start focusing on building income right now, okay? So rather than building a mountain of money, a big net worth, what I would propose to you is that what you actually should be doing right now is building a stream, okay? Stream of cash flow. Now, whereas a mountain is big and it's solid and immovable and unadjustable, a stream is fluid. Its path can be changed, its size can be altered, and it alters its course naturally to the conditions of the landscape that it flows through, right? So if you want to build certainty in your ability to become financially free or to retire someday, and you want to maintain your standard of living, instead of a huge mountain of money that represents a massive net worth that can't move, that can't adjust, that can't do anything but sit there and let the taxes and the fees and the market forces and the inflation erode away at it year after year, decade after decade, build a stream of money that represents enough cash flow to cover your expenses, and build a stream that you can control and that you can grow and that you can adjust as the economic landscape adjusts around you. Okay. Now, why is cash flow a more meaningful metric than net worth? Well, for one thing, it's a far more comprehensible number. Okay. Truth be told, I don't have a category mentally for $8.3 million. I can't comprehend how much money that is. Okay. I just don't. I don't make that kind of money. I don't spend that kind of money. I can't really fathom what that means. Okay. But well, let's stick with my 100K a year number. Okay. If I'm making 100K a year, I need roughly 8,300 a month to sustain that standard of living. Okay. Now, 8,300 to me sounds far more achievable than $8.3 million, right? The other reason the changing your focus from net worth to cash flow is that if you build up an investment portfolio that provides 8,300 per month in cash flow, you win, and you win forever, right? And you can do that as soon as it happens, right? I don't have to get to 55 or 65 with $8.3 million and hope that that's enough that it will be, it'll sustain me for the rest of my life, right? If I can generate a portfolio of investments that generates 8,300 a month that I can control, that I can adjust, that can, I can tweak so that I can respond to things as they change, economic conditions as they change, then I win. Okay. And what's even cooler about it is as soon as I can make that happen, I win, right? I don't have to wait until I'm 55 or 65 like retirees used to do so that they had their employer's permission and the Social Security Administration's permission to retire and collect a pension or collect Social Security, right? If I can build up that 8,300 a month in cash flow when I'm 35 or 40 or 45, I win, right? And I can be financially free and I can stop doing the 9-to-5 thing then, and I can go out and I can start figuring out what else can I go do with my time? How can I have an impact in my family, in my community, at my church, in the world, right? What is it I want to do with my time for the rest of my life? Okay. Now, creating an income stream of 8,300 a month might still sound daunting, right? That's not chump change. That's not easy. And it's not something most of us are trained to do. Okay. But does it sound more realistic than building an $8.3 million net worth in your 401k? And does it especially sound like something you could probably do more quickly and more believably than building an $8.3 million in your net worth in your 401k? It sure did to me. Okay, when I was going through this. Okay, so another reason, and I kind of mentioned this a minute ago, another reason that a stream of cash flow rather than a mountain of money is so powerful is you have so much more control. Okay, if tax rates change, if interest rates change, when inflation rates change, if you're managing your investments that produce cash flow, you can use that cash flow to pivot your strategy and invest in whatever ways make sense, right? Whatever ways are favored by the new rates, okay? Now, I know your financial advisor and everybody in the mainstream media always tells you the stock market is the way to go, right? It's the most powerful generator of wealth in history. It always goes up over time, right? Well, in the US, historically, that's true, okay? But if you look across the Pacific in Japan, their stock market has never recovered its all-time high from December 1989, okay? Now, could that happen in the United States? Absolutely could. We could hit a peak where the economy, for whatever reason, changes, and the stock market never recovers that, whatever peak it hits, right? Or it takes really, really long time, right? Maybe Japan will do it someday, but it's been, 30 years, and we're still waiting, right? So if the stock and or bond market, which is kind of what you're traditionally trapped in the qualified retirement plan world, if those have a major shift where things change and all of your funds are tied up in a mountain of money in one of those qualified plans, there's really not much you can do to pivot. You're stuck doing whatever it is you can do in those vehicles, right? And if all that will give you is sideways performance for 10, 20, 30 years, there's really nothing you can do about it, okay? Cash flow is powerful because you can change, you can pivot, okay? So what does that look like? If it's not, money trapped in a qualified plan, what does that streaming cash flow look like? Well, it could involve doing what I'm doing, which is building a portfolio of cash flowing real estate, right? You could do that in single family homes. You could do that in multifamily properties. It could be commercial real estate. It could be private lending to other real estate investors. There's lots of ways you could do that. Okay. Another completely different strategy is you could still build up cash flow in the stock market, right? Maybe you build up a portfolio of dividend stocks, or maybe you learn to sell put options for income. Okay. You could build up cash flow by investing in oil and gas wells. Okay. You could build up cash flow by investing in private businesses. You could start your own business. There's a lot of things you could do to start building a stream of income and working towards your financial freedom. Okay. But the first thing that you need to figure out is, what is that number? Okay. What is that target? All right. So I told you, for me, it was $8.3 million. That was depressing. As soon as I switched my perspective and I went, okay, I don't want the mountain of money. I want the stream of cash flow. That number became much more manageable. Okay. So your homework for tonight is to go figure out, what is your target? Okay. Forget the mountain of money. Figure out, how much would you need on a monthly basis? How big does that stream of cash flow need to be for you to be financially free? Okay. Now, there's a couple ways you could do that. If you keep good financial records, just look back at what you've done over the last 6 to 12 months. What's your monthly average expenses? And that's your target. Okay. Now, the other way to do it, it's a little more rough but easy, is figure out your monthly gross income. Okay. Subtract out all your income taxes, your payroll taxes, your Social Security, Medicare, right? All your taxes, and then deduct anything that you're saving that's not currently supporting your lifestyle. And whatever you're left with, that's your target. Okay. Because really that's the amount of money that's available to support your lifestyle today. Okay. So gross income minus all your taxes, minus anything you save in your 401k, a brokerage account, savings account, anything that you're saving, subtract that out. That number at the bottom is your new target. Okay. That's how much cash flow you need. It's that simple. Okay. So in the future, we are going to talk about, more details about what does it take to start building a stream of income, right? How do we shift our mindset from needing a mountain of money to building a stream of cash flow? Okay. We'll talk about that in future episodes, but your homework for tonight is go figure out, to start, what is that target? Okay. And I bet that you, just like me, will find that number much more palatable, much more believable, and a huge relief. Okay. So work on that, and I will catch you in the next episode.